Today I'm going to go through some other adjustments with actual calculations for you. Right, the first example, they give you a pre-adjustment trial balance for rent, and that amount of 198,000 is the amount of rent that you've actually received. And the adjustment tells you that rent was received 1 month in advance and monthly rent was increased on the 1st of February. If you draw a timeline here, that will mean we have 11 months here. We had one more month, and because we received 1 month in advance, that means we've received in total for 11 plus 1 plus 1, which is 13 months. If you use an equation now, I'm going to call the original rent X. So in other words, I'm going to have 11 months of X. These 2 months here, if you add 10% to X, you'll get 110% of X, which simplifies to 1,1x. If you added 15%, it would be 115%. 115 over 100 simplifies to 1.15, and so on. So in other words, then we've received 2 months, that's February and March, of 1,1x, and that gives you the 198,000 that was in the trial balance. You then solve for x and you get 15,000. Please remember that the 15,000 is x, which was the original rent, but the one you've received in advance over here must be 10% more than that. So if you take 10% of 15,000, that gives you 1,500. Add it on, you get 16,500. Now the question we need to ask, have I received too much or too little? Obviously here we received for 13, so it's too much. So you're going to need to decrease rent by 16,500, and rent received in advance is an income received in advance, which is deferred income. If they tell you rent was increased by a rand figure, then your equation would look like this. You'll still have 11 months of x, then you have 2 months of x plus 1,500, and then you solve for x. Once again, don't forget to add the increase in rent at the end. Sometimes they tell you rent decreases. If rent decreases by 10%, if you take 100% minus 10%, you get 90%. And 90 over 100 simplifies to 0.9. If rent decreased by 15%, 100 minus 15 gives 0.85, and so on. So increase 1 comma whatever the increase is, and decrease, subtract from 100 what the actual decrease was, and get the percentage that the new amount's going to be. Right, the next thing I want to look at is loans and interest on loan. In your pre-adjustment trial balance, you've got a loan figure here. They tell you interest on loan for the year is 48,000. They are telling you your actual expense there for interest. So in your income statement, under interest expense, you record that 48,000. But then they go on to tell you that interest is capitalized. In other words, you're going to go to your loan of 300,000 and you're going to add 48,000 here. So because interest is capitalized, you add to the actual loan figure. Now, the next part tells you that we're going to make a monthly loan repayment of 20,000 Rand until the loan is settled. You need to know your definitions here. Non-current liability means you've got more than a year to pay back. Current liability means you've got less than a year to pay back. So if we're going to pay 20,000 Rand per month until the loan is settled, you take 20,000 times 12. Of this loan balance, 240,000 does not have more than a year to repay, or you don't have more than a year to repay rather. So we left here with 240,000 here. That is the part of the loan, up here, 108,000 is the part of the loan that you've got more than a year to pay back. This 240,000 we move down to here, 12 times 20,000, and that part of the loan you've got less than a year to pay back. So we're not saying we don't owe the money, we're just saying it is a different type of liability. You leave the part up here that you've got more than a year to pay back, and the part that you've got less than a year to pay back, move down to your trade and other payables note. And then just remember, if interest is not capitalized, then it will be expenses accrued rather, okay, not, you won't add it to your loan. And then sometimes they don't give you that interest figure. If that's the case, you're going to do the following. You take the loan at the beginning of the year, you minus your total repayments for loan and interest, you add interest, which in this case we are going to make X, and that will give us the loan at the end. So in other words, you make interest X and then you solve for X, and that will give you your interest figure. Okay, the next one is your salaries and wages. Right, if you look at the pre-adjustment trial balance, we've got some opening totals there. Those are what we fill in first. So the 850, the 79,200, and the 134050 get filled in under your income statement, salaries, pension, and medical aid. Then they tell you that no entry was made to record a salary of an employee on leave, and then they give you details. Right, the gross salary is the total expense for the business. Because we haven't recorded the salary, we haven't recorded enough here, so we're going to add the gross salary. But that salary doesn't all go to one person. So in the payables note, we're going to break up that 25,800 and record it in terms of who is owed what. So of the 25,800, SARS is owed 4,800. Pension is owed 1,850. Medical aid is owed 1,200. And then if you work out your net salary by taking gross salary minus deductions, that is what is owed to the worker. So if you look at your double entry here, you are debiting salaries with the total, and then in the balance sheet notes, or the notes in the financial statement, should I say, you take that amount of 5,800 and split it up depending on who gets owed what, remembering that the net salary is what you owe the worker. Now this here goes on to say that the business contributes on a rand for rand basis to both pension and medical aid. That means the business has additional expenses now. Those additional expenses must get added as part of your contributions. Now, from what I've seen, most pupils remember to do this, but they forget the double entry. They forget that that 1850 is also owed to pension. That 1200 is also owed to medical aid. In other words, wherever there's a deduction and a contribution, you must show two entries here and then add up for your final answer. So, in summary then, the gross salary is the total expense for the business. In the payables note, you split up who gets what. If the business contributes over and above, those are additional expenses, and those also get owed to pension fund, medical aid, or whatever. So don't forget deduction and contribution where relevant. And then the last one is your provision for bad debts. Once again, we're going to start off by filling in our opening totals. So we have debtors control of 130,000, provision for bad debts 6,500. And then they say provision for bad debts must be adjusted to 6% of debtors. So you take your debtors figure of 130,000, you multiply it by 6%, that gives you 7,800 rand, which you write in straight away. That figure is going to be negative, alright, because we're going to subtract that to get your net trade debtors in a minute. If you look here, we've got 6,500, we want 7,800, so we need to increase it by 1,300. If you increase provision for bad debts, that's going to be an expense. If we were decreasing provision for bad debts, then instead of writing that here, then that would become an income. Remember as well, if there are any adjustments that affect debtors control, add or subtract them as necessary. Get the 130,000 or whatever the answer is there, multiply by percentage and put the answer straight away. Then look at what you've already got to see whether you need to increase or decrease your provision for bad debts. Alright, my advice to you now is to practice as many financial statements as possible because it's going to be a major question in your June exams, your end of year exams, particularly it's going to come up in paper one. So you need to be very familiar with this work so that you can get good marks for your income statement and your balance sheet and notes, whichever you're asked to do. Okay guys, that's all for partnerships now. Thanks.